Big news out of the European region. The Bank of England sticking to its plan to buy bonds with $202 billion of newly printed money. It also kept the interest rate at 0.5% as expected. Let's bring in Daiwa Securities economist Colin Ellis to talk about the decisions. Ellis was also a senior economist at the Bank of England, and he joins us from London. Ellis, good to have you. Colin, excuse me. Good to have you with us. The decisions, first of all, the interest rate decisions. Any surprise there? And also in terms of them not extending their asset purchase scheme?
Oh, good morning. I mean, the rate decision to hold at 0.5% was widely expected, and I think we all thought they'd do that today. There was really no surprise there. But in contrast, the asset purchase scheme, there had been quite a bit of demand in the market for the bank to extend that today and announce it was using up the rest of its £150 billion allotment.
Colin, it's Mark Crumpton with Carroll. Do you think this is a sign that QE won't be extended further in the future?
Well, I think it's too early to say at the moment. It's certainly true that the market was probably getting ahead of itself a little bit in expecting QE to be extended today. And we saw the reaction in yields after the announcement was made. But really, the decision to extend QE further on in the year will depend on how the economy plays out. Certainly, if you continue to see some encouraging signs in the real economy, and the MPC remains as content as it appears to be with the impact of QE, 125 billion could be your lot.
Hey, Colin, there was a headline that Mark and I talked about earlier, and this was the Bank of England reducing its size of individual gilt purchase auctions. Give us some context of that and whether or not this is a significant development.
Well, personally, I don't think it was. I mean, the bank's been very clear that it tries to buy its gilts or indeed its corporate bonds or commercial paper or whatever it's buying in sizable chunks or steady chunks, and particularly on the gilt side, where they've tended to be somewhere between £3 and £3.5 billion at a time. Now, the bank is most of the way through its 125 billion purchase programme, so the decision to maybe slim down a little bit going forwards still leaves them on track to finish by the end of this month.
Colin, do you know the green shoots? I'm almost tired of saying it, but that's what everybody's saying. Are the ones we've seen, are they strong enough for the bank to start thinking about the timing of an exit strategy, which is something a lot of people have been saying, even on this side here? Where's the exit strategy? Is it in place? What's the plan?
Well, I think the really interesting thing there is the bank already has started thinking about what the exit strategy will look like. I think it's got more work to do there. But perhaps it's still a little bit too early to be talking about the timing of an exit strategy. I mean, today's move was a clear signal that the bank is not in thrall to the markets. It won't just keep on buying assets because the market expects it to. But I think they're probably still not thinking about selling off those assets or issuing short-term paper to mop up that liquidity just yet.
Why is it so early, though?
Well, the UK economy has really come out of recession, or looks to be coming out of recession, rather, somewhat earlier than a lot of its international counterparts. The closely watched PMIs that we put a lot of weight on here at Daiwa have actually ticked up above 50 in recent months and suggest that the economy grew in both May and June. Now, if you contrast that with, say, Germany or the euro area as a whole, the picture there still looks much bleaker.
Colin, what was lost in this news today? What is it that people were not getting from the Bank of England's policy stance today?
I think the market got it wrong because maybe a few too many people focused on the flow of asset purchases. They saw the bank buying so many gilts every month, typically around 20 billion or so, and they assumed that would continue until the economy bottomed out. Whereas, in fact, my view is that the bank was aiming for a stock injection of money into the economy.
Is that old adage, that not seeing the forest through the trees type thing?
It could be. It could also be that clearly the bank's entrance into the gilt market has been very distracting for market makers across the board, and they may have been paying so much attention to what the bank was doing and lost sight of the fact that actually there are other players out there as well. There are some people who think that maybe the market started to get a little bit too hooked on QE, too hooked on these asset purchases, and as a result, maybe today's move will be a wake-up call for those people.
Hey, Colin, on a more macro level, obviously earnings is a focal point here. We have those Alcoa numbers after the closing bell here. It got off to a pretty good start here. We were watching these numbers very closely. That definitely gave some support to the overall European trade in today's session. What do you think is that big macro earnings environment right now, especially for the Euro region?
Well, for the Euro region, I'm afraid I think it looks a little bit more downbeat than some of the more Anglo-Saxon counterparts. I mean, Europe really is Germany writ large, if you wanted to simplify it intensively. And Germany is essentially waiting for the rest of the world to recover to pull it out of recession via its exports. So in that regard, I wouldn't expect some very strong earnings numbers out of Germany anytime soon, and that could weigh on European stocks.
All right, understandable. All right, Colin, thank you so much. Colin Ellis, economist at Daiwa Securities, joining us from London.